Have you noticed that you need more and more money to buy the same things? That's inflation in action, and it can eat away at your savings if you don't take action. In this video, you'll discover the 5 best assets to protect and grow your money during times of inflation. Stick around until the end to learn how to keep your finances safe. Inflation reduces the purchasing power of your money, meaning that over time, your savings are worth less. Without the right strategies, you could lose a significant portion of your wealth. Fortunately, there are assets that have historically proven effective in countering inflation. Today, we'll explore 5 of them and how you can incorporate them into your financial strategy. First up, gold and precious metals like silver and platinum are tangible assets that have served as a store of value for centuries. These metals have a limited supply, which makes them a reliable option during times of economic uncertainty or inflation. How do they work? When inflation rises, the value of paper money goes down, but gold and other precious metals tend to hold or even increase their value. This happens because investors turn to these assets as a safe haven, increasing their demand. Ways to invest in precious metals. Direct purchase. Buy gold bars, coins, or jewelry and keep them in a safe place. Metal-backed ETFs, investments in funds that track the price of gold or other metals. Mining company stocks. Companies that mine and sell precious metals, which adds an element of risk and opportunity. Let's say you buy 10 grams of gold when its price is $60 per gram. If inflation raises the price of gold to $70 per gram, your $600 investment is now worth $700, protecting your money and making a profit. Things to consider. Advantages. A tangible asset, recognized globally, and a safe haven. Disadvantages. It doesn't generate passive income, its price can be volatile in the short term, and storage costs can be significant. Gold is a great option for preserving value, but what if you could also generate steady income? That brings us to real estate. Second, real estate includes residential, commercial, and industrial properties that you can buy, rent out, or sell for a profit. Their value tends to increase over the long term, especially in growing markets. How do they work? Real estate protects against inflation because property values and rents usually increase along with overall prices. This makes them a source of stable income that keeps up with the cost of living. Ways to invest in real estate: direct purchase, buy properties to rent out or sell later, real estate investment trusts, REITs, investments in a diversified portfolio of properties managed by experts. Real estate crowdfunding, platforms that allow you to invest in real estate projects with a small amount of money. Imagine you buy a property for $200,000 and rent it out for $1,000 a month. If inflation goes up 3%, you could increase the rent to $1,030 the next year, ensuring that your income grows at the same rate as prices. Things to consider. Advantages: source of passive income and capital appreciation. Disadvantages: requires a high initial investment, ongoing maintenance, and can be difficult to sell quickly. If you're looking for a more accessible and liquid option, stocks in certain companies might be the key. Let's see how they work. Third, stocks represent a portion of a company's ownership. During inflation, certain industries, like consumer staples and energy, can pass on increased costs to consumers, maintaining their profit margins. How does this work? When companies raise their prices due to inflation, their revenue and profits can grow, which is reflected in the value of their stock. This makes them a tool to protect and grow your money. Ways to invest in stocks. Direct purchase. Invest in individual companies with competitive advantages. Index funds or sector ETFs. Access a diversified portfolio in key sectors. Active management. Hire a manager to select the best stocks for you. If you invest $1,000 in a food company with 8% annual growth during an inflationary period, you could end up with $1,080 a year, plus any gains in its stock price. Considerations. Advantages: high return potential and protection against inflation. Disadvantages: higher volatility and risk of loss if you choose the wrong stocks. Stocks offer growth, but if you prefer to diversify into emerging assets, cryptocurrencies can be an interesting alternative. Fourth, cryptocurrencies are decentralized digital assets that use blockchain technology to ensure their security and transparency. Bitcoin and Ethereum are 2 of the most well-known. How do they work? Many cryptocurrencies have a limited supply, which gives them similar characteristics to gold. During inflation, their value can increase due to the demand for alternative assets. Ways to invest in cryptocurrencies. Direct purchase. Buy cryptocurrencies on trusted exchanges and store them in digital wallets. Cryptocurrency funds. Managed investments in a diversified crypto portfolio. Staking. Earn rewards by keeping your cryptocurrencies locked in the network. If you buy 0.1 Bitcoin at $30,000 and inflation pushes its price to $40,000, your original investment of $3,000 is now worth $4,000. However, prices can fluctuate considerably. Considerations. Advantages: high potential returns and global access. Disadvantages: extreme volatility and lack of regulation in some countries. Finally, let's look at an asset specifically designed to protect you from inflation. Fifth, inflation-linked bonds are financial instruments issued by governments or corporations that adjust their principal value according to an inflation index. This ensures that your investment doesn't lose purchasing power and at the same time generates income in the form of interest. How do inflation-linked bonds work? The face value of the bond increases with inflation, which means your investment automatically adjusts to changes in the consumer price index. In addition, the interest payments are linked to this adjusted value, providing a source of income that grows along with inflation. Ways to invest in inflation-linked bonds. Government bonds. In the United States, TIPS, Treasury Inflation-Protected Securities, are a reliable option. In other countries, there are similar bonds like UDS bonds in Mexico or index bonds in Europe. Bond funds and ETFs. These offer access to a diversified portfolio of inflation-linked bonds, which reduces risk and makes management easier. Indexed corporate bonds. Issued by companies that adjust the principal based on inflation indices. Let's say you buy $10,000 in TIPS with an interest rate of 0.5%. If inflation is 4% per year, the value of the bond will increase to $10,400, and the interest will be calculated on this new amount, resulting in a higher payment than the initial one. Considerations. Advantages. They directly protect against inflation and are ideal for conservative profiles. Disadvantages. Their base return can be low compared to other assets, and in some countries, inflation adjustments may be subject to taxes. With these 5 assets, you can create a diversified strategy to protect and grow your money during inflationary periods, regardless of the market you are in. Inflation doesn't have to be a roadblock to your financial success. By understanding and using assets like gold, real estate, strategic stocks, cryptocurrencies, and inflation-linked bonds, you can not only protect your money, but also turn these challenging times into an opportunity for growth. Now it's your turn. Which of these assets do you think is the most suitable for your situation? Leave me your answer in the comments. And if you want more strategies like this, subscribe to Road to Success, turn on the notification bell, and share this video with someone who also wants to protect their money. Remember, in finances, the key is not just surviving, but thriving. See you in the next video.